Today's earnings from Wednesday had the world's richest tech giants taking out heavy debt just to pay for AI servers. And then we saw physical retailers surviving through tactical overnight operations, plus an online car dealer winning a massive advantage strictly by accident.
Yeah, the day splits perfectly between those two realities. The biggest takeaway for me is the sheer physical cost of the AI buildout. It is completely warping the financial profiles of Microsoft and Meta. We are watching historically capital-light software giants turn into heavy industrial operations.
Right. The accounting gymnastics here are wild. It is Microsoft is literally rewriting its depreciation rules. They extended the estimated lifespan of their servers from 15 to 25 years, starting in 2027. They are doing that just to spread out the pain of an upcoming very expensive CapEx bill. And Meta is feeling that exact same pressure.
They are. Meta actually halted their historical stock buybacks for the first half of the year. Instead, they took on major long-term debt specifically to fund their infrastructure spending. That decision just crushed their free cash flow sequentially. Wall Street is tolerating the cash burn for now because cloud growth looks strong, but the cash flow collapse underneath is severe.
So big tech is drowning in data center costs. But then you look at the physical retail side of the batch, and they are basically, refusing to accept any operational downtime. Starbucks is a perfect example. Instead of absorbing weeks of lost revenue for a massive cafe teardown, they're pivoting to targeted overnight store uplifts.
Right. It's a very smart operational hack. They swap the seating and lighting completely overnight, and the store just reopens by sunrise. Let me add this too. If you see the headline that Starbucks' global revenue declined slightly, ignore it. That top-line drop is strictly an optical illusion from licensing their Chinese footprint to a joint venture. Their real underlying comparable sales are actually growing.
Well, that is a helpful earnings quality warning. Speaking of optical illusions, I want to talk about Carvana. They just caught a huge tailwind completely by accident. The FTC rolled out new regulations forcing traditional auto dealers to publicly list their mandatory junk fees online.
Exactly, because Carvana never charged those hidden fees historically. They didn't have to change a single thing. Competitor website prices just floated up overnight. That gave Carvana a massive perceived affordability advantage. It's fascinating how consumer protection laws can inadvertently warp standard industry competition.
Just a total accidental mode. I will say we probably still need to be a little skeptical of their headline profit. Management pushed through an unannounced retroactive stock split between filings that heavily padded their base earnings per share. So the physical unit momentum is excellent, but that math is definitely less clean.
That's the reality of this entire batch. Going forward, I think you really have to watch how long Meta can sustain this capital drain before investors panic. You also need to watch Carvana next quarter, specifically when some of their beneficial revenue treatments automatically expire.
We will definitely see who is still standing when that math normalizes. The individual company episodes in the feed hold the actual call transcripts uncovering exactly how these platforms are stretching their server lifespans and pulling off their overnight renovations. Catch you next time.